Good evening. Welcome to the half-year results for Redefine for the 6 months ending February 14. Tonight we'll start with me doing the strategic overview. David Rice will then take you through the property portfolio. Andrew will give you the results, and then I will do the conclusion and prospects. So, strategic overview. Our distribution, I'm happy to say we've got a solid set of results and it's ahead of market guidance. It's been driven by sectoral and geographical diversification. Our corporate activity has been on the increase since conversion to REITs with the 2 billion annuity acquisition. Property acquisitions total 2 billion. Our new development pipeline of 2.8 billion, 157,000 square meters. Our Fountainhead holding was increased during the period to 66%. And as you all know, we are looking at making an offer for the assets of that company. More of that later. Our international opportunities are looking more and more attractive relative to local opportunities, and we are looking out seriously now to expand our international opportunities. We have 3.2 billion invested in Australia. A renewed focus is on redevelopment as opposed to acquisitions. 700 million is in progress in terms of adding value to our existing portfolio, and our strategic and risk focus has been tweaked to meet the more changing and challenging environment. Strategic priorities and action plans. In 2014, we said we were going to dispose of our government tenanted portfolio. We went a long way down the road on a listing of that. Unfortunately, at the end, we had difficulties with our BE partner who couldn't deliver. We then had the increase in interest rates, and it would have been too dilutive for us to list that separately. But the good news is that with the budget speech earlier this year, we are getting leases, 3-year leases on the portfolio. So the pressure is off. We will still look to dispose of some of the portfolio. After annuity, and if we're successful with Fountainhead, government will be in total about 6% of our portfolio. So certainly not the same risk, and that will come down. The rationalization of our property portfolio is ongoing. What we are looking to do is create a pyramid where we have really a base of very defensive properties, long leases in excess of 5 years, blue chip tenants, fully maintaining, repairing. Then our core portfolio, good quality properties, shopping centres where high rate of renewal, good chances of renewal, and at the top of the pyramid, a much smaller component of our secondary properties, those that we can add value to and which give higher yields. So we also want to continue to acquire good quality properties and dispose of some non-core assets, continue to recycle capital, and the restructure will continue without diluting earnings materially. We're also going to implement a BEE strategy to improve our BEE score. So our focus from a management point of view was renewing government leases. We now have 60% of our revenue contractual, whereas previously the bulk of it was on monthly or 1-year leases. We took transfer of our share of Montpellier Mall at the end of March, and we've got further acquisitions totaling 1.1 billion in the process of transfer. The establishment of the BE Trust needs to be approved by unit holders, and a circular in this regard will be sent out shortly. Our priorities in 2014 were to take on the Fountainhead property management. That's been done successfully and implemented. We're improving our management information flow continuously, and that continually reviews and improves. Focus on cost of services through leverage economies of scale. It's under continuous review, but we've been very successful this year, as you'll see when Andrew goes through the results. Introducing technology-based applications to improve communications with staff. That's something which is ongoing, and it works for most people except me because I don't know what I'm doing. And introduce electronic communication platforms to shoppers and to support tenants. That's something which is taking a lot of time and attention. We've made considerable progress in all of the above, and we emphasize on maintaining margins despite continued above-inflation escalations in utility costs and rates. Strategic priorities and action plans. We said we want to exit the remaining Hyprop holding, which we've done. Increase our holding in Fountainhead, which, as I said earlier, is now 66%. We're now engaging with the independent Fountainhead board and the regulatory bodies to acquire the remaining Fountainhead assets. As we stand today, we do have FSB approval for the offer. We are awaiting some feedback from the JSE and, of course, from the independent directors of Fountainhead. But hopefully within the next 4 to 6 weeks, we should be in a position to make an offer, and then it will be up to shareholders of Fountainhead to decide whether or not to accept that offer. In the interim, we won't be buying any more Fountainhead units. We're happy with our stake in terms of units at where we are. Management of debt. We wanted to improve our loan-to-value ratio. That's under continuous review, and we will be looking at how we improve that in the course of the next 6 to 12 months. The ADR, we were the first REIT to do it, and we need to now do some marketing around that to get it trading. Increase our funding from debt capital markets, we've done successfully. For the first time now, after these results, we've introduced a dividend reinvestment program, and that circular will go out shortly, and shareholders will be able to elect as to whether they want cash or units. Restructuring of expensive debt, we continue doing that. We have done some, and the capital conversion from the debenture structure is underway. So from our point of view as management, we've adopted a very vigilant approach to the upward interest rate cycle. Fixed debt is now a minimum of 75%. It's actually 81%, but come down with the acquisition of Maponya, and a strong focus on broadening funding sources to face off possible downgrades of sovereign debt. Priorities. We set up a South African Reserve Bank approved structure to invest in offshore property directly. This has been done, and we have permission to invest substantial amounts offshore if and when the right opportunities present themselves. We can invest in listed offshore securities and direct property at probably more attractive yields after gearing than we can get in South Africa. But again, one has to be very circumspect about the type of asset that we do buy and who our partners would be. And we have geared our Cromwell holding, which we now hold directly, and we've geared that in Australia, which gives us a hedge against the currency. So as I said, we've got the holdco in place. The inward listing of RR plc was very, very successful. The share price is now fully fungible. The units are trading in nice volumes both here and on the LSE, and we will probably at an opportune time reduce our holding in Redefine, given its relatively low yield, if we can find a better opportunity and a higher yielding opportunity to invest with Redefine in a direct property. The management company was internalized. We got 69 odd million units. We took the 50% investment in North Point in Sydney, and Cromwell is now directly held, and over time we think we can double that investment. In terms of adding value, we're redeveloping existing properties continually. We're making significant progress on our development pipeline. We continue to pursue pre-let tenant demand-driven development opportunities, although these are becoming more and more difficult to get yields out of, given the resistance to higher rentals. And of course, we are providing redevelopment services to Fountainhead in terms of their portfolio. So we have a current development pipeline of 3.5 billion, of which new developments are 2.8 billion and redevelopment projects are 700. So what differentiates Redefine from other companies? What do I think? I think, first of all, we have a very unique hands-on management approach right from the top. We don't have a hierarchy. Decisions are made by our exco. We're able to react quickly and definitively. Our quality of our portfolio has improved remarkably. We now have a good quality, diversified portfolio. We have development capability with a substantial pipeline, global diversification in both Europe and Australia, which we intend to expand, a very robust balance sheet, recycling opportunities on our capital, and a lot of agility in the way that we conduct our business. A couple of interesting stats is our average rental per employee is just under 13 million per annum. Our average rental per tenant is 808,000, and our average value per property is 92 million. With that, I'll hand you over to David, who will take you through the property portfolio, and then I'll come back and conclude on prospects and take any questions. Thank you. David.